All right, let's talk about taxes. I know. But we're going to tackle one of the most confusing parts of the whole U.S. tax system, the marginal tax bracket. By the time we're done here, you'll get exactly how it works. And more importantly, you'll see why getting a raise is always a good thing.
Okay, so let's just jump right in with a classic question, one that honestly creates a ton of anxiety for people. Have you ever wondered this? If a pay raise pushes you into a higher tax bracket, could you actually end up with less money in your pocket? It's a super common fear, but is there any truth to it?
Well, that question leads us right into our first big topic, what I like to call the big tax misconception. We are going to tackle this financial myth head-on and put it to rest for good.
So here's the fear, right? You're cruising along in, say, the 12% bracket, and then you get a nice raise that bumps you into the 22% bracket. The panic sets in. Does that mean your whole income, every single dollar you earned all year, now gets taxed at that much higher 22% rate? I mean, it's an understandable fear for sure. But, and this is a big but, thankfully, that is not how our tax system works. Not even close.
So if that's the myth, what's the reality? Well, the answer lies in understanding that the U.S. has what's called a progressive tax system, and it's all built on this idea of marginal rates. Let's break down exactly what that means.
Okay, this is the key. Your marginal tax rate, it's the rate you pay on only your next dollar of income. Think of it as the rate on your highest dollar. It only applies to the chunk of money that falls into that specific bracket, not, and this is the important part, not on all of your money. You know, the easiest way to make this crystal clear is with a simple analogy. I want you to stop thinking of your income as one giant pile of money. Instead, picture it like a stream of water that you're using to fill a series of buckets. Each bucket represents a different tax bracket. Here's how it works. As you earn money, your first dollars start filling up that first lowest rate bucket. That one's taxed at just 10%. Now, once that bucket is completely full, any new money you earn just spills right over into the next bucket, the 12% one. And here's the crucial part, only the money that actually lands in that second bucket gets taxed at 12%. The money back in that first bucket, it stays safe, still taxed at 10%. And this process just keeps going, bucket by bucket, for each bracket you reach.
All right, so now that we've got the whole bucket idea down, let's look at what those buckets actually are. These are the official marginal tax brackets for the 2026 tax year.
So here they are, the buckets in all their glory. You can see there are 7 different tax rates, starting down at 10% and going all the way up to 37%. And take a look at the income ranges for each bracket. You'll notice they're different, depending on if you're a single filer or if you're married and filing jointly.
Yeah, check out how much those income thresholds change based on filing status. Let's just take the 22% bracket as an example. For a single person, you hit that bracket once your income passes about $50,000. But for a married couple filing jointly, that same 22% bracket doesn't even start until their combined income is over $100,000.
Okay, this is my favorite part. This is where the rubber meets the road. Let's see how this all comes together in a real-world calculation. We're going to put that bucket analogy to work with some actual numbers.
Let's cook up an example. Imagine a single person, and let's say their taxable income for the year is exactly $60,000. Now, if you look at the chart, technically they are in the 22% tax bracket, right? Because their income is over that $50,000 and change threshold. But what do they actually pay in taxes? Okay, let's start filling the buckets. First up, the 10% bucket. The first $12,400 of their income gets taxed at 10%. That comes out to $1,240. Boom, that bucket's full. All right, next, the money starts spilling into the 12% bucket. That's all the income they earned between about $12,000 and $50,000. That whole chunk is taxed at 12%, which adds another $4,560 to their tax bill. And finally, we get to the last part of their income. The rest of it, the final $9,600, spills over into that 22% bucket. And remember, only that amount gets hit with the 22% tax rate. That comes out to $2,112.
So now we just do the simple math. We add up the tax from each of those buckets. You've got the $1,240 from the first, plus the $4,560 from the second, and the $2,112 from the third. The grand total for federal income tax this person owes, $7,912.
And look at that. This illustrates the whole point perfectly. Even though our person is technically in the 22% marginal tax bracket, are they paying 22% of their $60,000 in tax? No way.
Their actual tax rate, what we call the effective tax rate, is really just over 13%. That big, scary fear we talked about at the beginning, totally, completely busted.
So now that we've busted that myth wide open, what does this all mean for you? What are the big takeaways? Why does understanding this system actually matter for your financial life? Okay, here's what you really need to lock in. First, and this is the most important thing, a raise will never, ever cause you to take home less money. Period. It's impossible, because only the new dollars get taxed at that higher rate. And remember the two key terms. Your marginal rate is just the rate on your last highest dollar earned. But your effective tax rate, that's your total tax divided by your total income, that's the number that shows what you actually pay on average. And let me tell you, understanding this difference is absolutely key to making smart financial decisions. And that really brings us to our final thought. You now have the tools, you get the bucket system, you understand your marginal tax bracket. So what's the next step? Well, apply it to yourself. Take a look at your own income, run the numbers through these buckets, and figure it out. So I'll leave you with this question. Now that you understand your marginal rate, what's your effective tax rate? Thanks so much for joining me.